All those things go into this calculation. How in the world are you going to know that if you don't have a loan officer and you're not in process and they don't have all your details? You're not. That's the point. Today's topic, how to calculate PMI. Well, my first response is you're probably not going to want to. It's quite complicated, but I'm still going to give you all the information. By the end of this video, you're going to understand the different types of PMI, some of the ways that you can possibly calculate the PMI as well, and understand all the variables that go into this based on the different loan programs. Stick around. Welcome to your one-stop shop for anything and everything mortgage education. I drop new videos every Tuesday and Saturday, so be sure to hit the subscribe button and hit the bell to be notified every time I drop those new videos. My name is Stephanie Weeks, and I have helped thousands and thousands of customers with millions and millions and millions in mortgage financing. And my goal here with this channel is to help you understand anything and everything that you can around mortgage education. I've been a loan officer for over 17 years, and I've been recognized in the top 1% in the country for loan originators as far as production. Thank you for tuning in. There's PMI, there's MIP, there's upfront, there's single, there's upfront and monthly. There's the 0.85 calculation, the 0.35 calculation, the 0.50 calculation, the 1% calculation, the 1.75. Have I lost you yet? Oh my gosh. There are so many variables that go into MIP and or PMI. Hang tight with me. I'll try not to bore you to tears, but I will give you information so that you at least understand what your options are and what goes into calculating mortgage insurance. 6. I have broken this down into 6 categories to quickly discuss with you guys today. So let's dive in. Number 1, MIP versus PMI. MIP is mortgage insurance premium. That's associated with government-backed loans, such as VA, FHA, RD. Then there's PMI. That PMI, that is private mortgage insurance, and that is on the private side. That is for conventional loans. Those are those differences. So when you hear those terms interchanged, or on different loan types, you hear them called different things, that is the reason. Let's dive into number 2. When and where does this apply? MIP, again, that's mortgage insurance premium on an RD loan. Now, not real often, but these calculations and figures do change. I'm giving you what they are as of now, and I'm gonna base everything for this video on purchases. Rule development, MIP. You have an upfront and you have a monthly. You have your 1% upfront that goes into the loan unless you want to pay it in cash, and it helps to continue funding the program and making it available. There's staffing and a lot of expenses that go into keeping these programs alive and active. So your MIP, you've got your upfront on RD. You've got your monthly on RD. The monthly is a 0.35% calculation. I'm going to break out the calculator later, so hang tight. Then we have FHA, another government-backed loan. Again, that's called MIP. And you've got your upfront as well, and you've got your monthly. I'm basing this off of a purchase with the minimum down payment. You've got 1.75% upfront, and you've got your 0.85% monthly calculation in that example. Next, we have VA. VA has no monthly, but has an upfront based on your eligibility, and there's a scale, and it could be as low as 0 or complete exemption. Then we've got PMI. Again, that's private mortgage insurance associated with conventional loans. Conventional, you can have many options as far as what you want. Most people know and understand the monthly. But in this video, we're going to get into more information that when you know and understand, there's actually more options than just the monthly. So, number 3, let's further dive in. Number 3 is let's talk about FHA calculations. I'm going to tell you how to calculate what this is going to cost you. With a $100,000 loan amount, remember I promised you, or I said in the beginning, you probably don't want to do this because it's complicated. You want to do it the right way. Here's how we do it. You have a $100,000 loan amount. You have a 1.75% funding fee. That's an upfront funding fee, or MIP, of $1,750. To accurately calculate the monthly MIP, you're going to have to take $1,750 because you're probably not going to pay that in cash. You can, but most people don't. We're going to add that to your $100,000 loan amount. Now we're dealing with a loan amount in this example of $101,750. Now we're going to figure out the monthly calculation. We're going to take our loan amount, $101,750, times 0.85 equals, divided by 12. The decimals are going to be off because this is my cheating way to do it, but that's $72.07 a month. So $100,000 loan amount, FHA purchase, upfront is $1,750, added to the loan amount to calculate your monthly of $72.07 that is added into your monthly payment. That is your FHA, MIP cost, and how to calculate that. Number 4, we're going to talk about the RD calculations now. So we're going to use our same example. Purchase, rule development, $100,000 loan amount. We've got a $100,000 loan amount. We have an upfront of 1%. That equals $1,000. We're going to add that to our loan amount. That way we can accurately calculate the monthly. We have a loan amount of $101 even in this example, times 0.35% monthly calculation, divide that by 12. We have $29.46 a month. That is your monthly MIP on an RD loan in this example. And that's how you accurately calculate that as well. Number 5, are you still with me? I'm on to number 5. We are going to calculate a conventional loan in this example. Here's what's so important and why I told you would probably not want to even attempt at this. On a conventional loan, you have so many options. Right now, I'm going to talk to you about the monthly option. And I'm going to give you an example and a calculation. But the RD and the FHA, those are what they are with the exception of certain situations, such as more down payment, things like that, okay? But they are what they are for the most part. With conventional, your PMI, it's not just it is what it is. It's based on your credit score, your debt to income before the calculation of the MI, your zip code goes into effect, purchase versus refinance, of course, we're talking purchase today, loan term, right, loan term, 10, 15, 20, 25, or 30 year. Also, how many borrowers, right, that also makes a difference, and loan amount, and I'm probably forgetting something as well. But all those things go into this calculation. How in the world are you gonna know that? If you don't have a loan officer and you're not in process and they don't have all your details, you're not, that's the point. But let's assume you have all of the data. We have a $100,000 loan amount. We're talking about PMI, private mortgage insurance. This is not an MIP calculation. $100,000 loan amount, purchase, and there's not going to be any upfront. Right now we're talking monthly only. So let's say if the calculation is a 0.47% calculation. So we've got $100,000 loan times 0.7% calculation, divide that by 12. We've got a monthly PMI that's added to your monthly payment for this example of $39.17. $39.17. And we're talking conventional, so right now we're not talking up front. 5, 4, 3, 2, 1, we're still there. Okay, great. Oh, hi, great. Welcome to number 6. Here we are. There are so many options with PMI and a conventional loan. There is your upfront, but that's called a single premium. If you choose to pay the upfront, you don't have the monthly. Remember the calculations we just did with RD and FHA, we had upfront and monthly? Well, with conventional, if you qualify, you can actually choose single premium, upfront, one-time payment, refundable or not, will affect that pricing. And if you do that, then you have no monthly at all. Most people do not know that exists, And in many situations, that's my favorite option and will save you the most amount of money. It is a significant reduction on the overall cost of mortgage insurance when you take that option. And you can do that with as little as a 3% down payment. So yes, you can have a 3% down payment, and there's a way to not have monthly PMI. Yes, that is correct. Then you have your monthly, which everybody knows about, and we just did an example of a calculation of that. We also have the other option, which is called lender paid, where you basically pay a higher interest rate, yes, for the life of the whole loan, but you pay a higher interest rate and your lender basically pays the mortgage insurance for you. I made a little cheat sheet for you, and I'm gonna put it as a link that you can download. It's MIP PMI ranges, and like I said, it's a little cheat sheet that I made for you guys that hopefully can help you have at least a general idea of everything we've gone through in this video today. So I will put that in the bio and or the comments below. Click that, and I hope it helps. Drop me a comment below. Hey, drop me a comment below. Type yes in all caps if this video has helped you and you have a better idea of what the heck PMI is versus MIP and an idea of what all that stuff means and how to calculate it. Yes, YES. If you like this video, please give me a thumbs up. If you didn't, give me a thumbs down. Be sure to leave a comment because I do appreciate the feedback, and let's connect. My Insta is _therealStephanieWeeks, and I look forward to your comments as well as your direct messages. Have a great one, guys, and thanks again for tuning in. Check out these other videos for more information.